Alright, so you should be able to see the stream there. I'll actually get the stream going on Discord as well. Let me know if that is alright. Jacoby, can you see the YouTube and the Discord stream alright?
Yep, you got it.
Perfect. Give it a couple more minutes here and then we'll be off to our lesson. Alright, perfect. Can you hear me?
Oh yeah.
Nice, sweet. I hope you all enjoyed your weekends, and we'll go ahead and get started here. So today's lesson is going to be on candlestick patterns. A lot of you guys have been requesting that we do something on candlestick patterns, and I think it's quite appropriate given the current market conditions and how sporadic it's been. It definitely gives you an upper hand to be aware of all of the patterns. So there's the disclaimer briefly, and yeah, our syllabus today is what are candlesticks and how do we read them? What are candlestick patterns and why are they important? How candlesticks can be used in order to determine market sentiment, and explore different types of candlestick patterns and how to utilize them. And there's another thing that we're actually going to go into called blending candlesticks, and that is quite interesting as well. So, um, as we all know, there's different types of charts. You know, as we can see on the screen here, we've got our bar charts on the bottom right, point and figure, you know, Heikin-Ashi line graphs. Um, and what we're going to be going over today is actually candlesticks. And I just wanted to briefly make sure that everyone understands some, you know, the basics of candlesticks. A candlestick is a way of displaying information about an asset's price movement. It is a charting tool. It's a form of a chart, basically. And candlestick charts originated in Japan over 100 years before the West developed the bar and point and figure charts. In the 1700s, a Japanese man named Homa discovered that there was a link between price and the supply and demand of rice, and the markets were strongly influenced by emotions of traders. Now, traders used the candlesticks to make trading decisions based on regularly occurring patterns that help forecast the short term direction of the price. Candlesticks do not reflect the sequence of events between the open and close of that candle, only the relationship between the open and the close, the high and the low are obvious and indisputable, but candlesticks and bar charts cannot tell us which came first. So, just to break it down here, this is how a candlestick is printed. For instance, here you're going to see this across the whole lesson today. So whenever we see a black candlestick where it has no white hollow um, aspect to it, that's actually going to be a bearish candlestick. It means that it opened at the high of that candle. It closed at the low of the thicker part of the candle called the inner body, and then we can see the two wicks, as we call them, on the high and the low. They display where this candlestick has been, but obviously not opened or closed at. So at some point within this time frame, it has made a high of up to this level and then a low of up to that level. But one piece of information that we can take from this is the fact that it's been here, it's been there, but it opened here and closed here. Now on a bullish candlestick, we would open at the low of that candle. We would usually see this as a green candle, and this is a red one. But for the purposes of this lesson, a lot of them are going to be hollow as in white for the bullish candles. But the same concept applies. The high on this wick here is the where it has been and the low of where it has been in that candle. But essentially through this time frame, it opened at the low and closed at the high. And what we do is we actually call this thicker part of the candle the inner body, and then these are the wicks on the top and the bottom, just to clarify that.
John, sorry to interrupt you.
Yeah.
Can you see if you can't fix your mic a little bit? It sounds like you're cutting in and out a little bit. I'm not sure if anyone else is experiencing that.
Okay, yeah, sure.
Perfect. Yeah, it sounds
How
a
about
lot
now?
better now.
How about now? Okay.
Yeah, thank
Perfect.
you.
All right, thanks for that. So, three main parts. So the body, which is represents the open to close range. So that is the thicker part of the candle here. Just as it would be on the bearish black candle or red candle, it would be thicker on the green or white candle, which would signify that it went up. Opened at the low, closed at the high, as we know. So the wick or the shadow, it can be called the shadow as well. So the inner body and this would be the upper shadow or the lower shadow. But wick does well because after all, it's a candle and candles have wicks, and that's where they get that from. Um, so the wick or the shadow that indicates the intra candle high and low. So the immediate candle high and low, so we're only specifying one particular candle as of now. If the upper shadow on the down candle is short, it indicates that the candle was near the high of the candle. So yeah, basically, if we can see that this is a shorter um, candle here, shorter wick, it basically means that we have had less price action towards the lower end of the candle, and it technically can be as long as it wants. And you'll see that you'll have large wicks and small inner bodies um, very frequently, or vice versa. Uh, the short a short upper shadow on an up candle dictates the close was near the high, and the relationship between the candles open, high, low, and close determines the look of the daily candlestick. Um, and the thing is each one of these candles can represent a different time frame. For instance, you can look at the 1 hour chart um, as though it would have every single candle would represent 1 hour, and you can see, for instance, on this candle here, we have a very standard inner body with a wick on the top and a wick on the bottom, very similarly to how we're looking at it there. And then you can see how some candles might not have much of a wick, but a large inner body, and some candles might have a large inner body and a large wick. It all depends. And they can all indicate different sentiment, and that's what we're actually going to go over today. So now that we understand the uh, formation of a candle, we're going to go into exactly what they mean. But yeah, basically the color which reveals the direction of the market movement, a green or white body, indicates the price increase, while as a red or black body shows the price decrease. So yeah. And this is another example of basically how it is. So we've got the real body, the inner body, the upper shadow or the upper wick, the lower shadow or lower wick. See, there's a few different types of uh, terminologies for it, but generally speaking, inner body and candle wick at the top. So candlestick formation. So this is another example here. As we can see, they're just larger inner bodies or real bodies. So this is actually really interesting what we're going to talk about here. So this is the high and low sequence of a candle. So within this one candle, we have our open and then our close. We've got our high and then our low, just as we would usually. We can see this is a really bullish candle. It opened at the low and finished at the high. Now there's a few things that happened within this candle. Let's say this candle is an hour long candle or even a weekly long candle. There can be hundreds, if not thousands, in some cases, of patterns that will dictate the formation of this candle. So this gives you an idea of two simple ways that we can look at what has actually happened in order to give us this candle. So, if we were to look at it as a line chart, it opened at the low, it opened here, all right, and it went down a little bit, right? So it went down to make that low and essentially rallied all the way through to make our high but then it closed slightly lower than where the high was. And that means that we've got our inner body where the open was here and then the close was there, but we can see that it poked up a little bit higher from where it closed and it went a little bit lower than where it opened. Now there's another way that this candle could have been formed, and not to confuse it with only these two. These are just two very basic ways that we can get this candle. And for instance, it could have opened at the low, it could have rallied all the way up to make the high and then crashed all the way down to make our 2 point here, our low, but it crashed down slightly lower than where it opened to give us that wick, and then ended up rallying up to where it closed, which was slightly beneath the high. So that's another factor. Sorry about that. Um, the candlestick formation high-low sequence. With a long green or white candlestick, the assumption is that the price. Sorry, hold on 2 seconds. Just put that underneath there. Anyways, so with a long green or white candlestick, the assumption is that the prices uh, advance most in that session. However, based on the high-low sequence, the session could have been more volatile. The example above depicts two possible high-low sequences that would form the same candlestick. So we can see that, there was two potential outcomes that could have formed this candlestick. Now, if we looked at this candlestick in a shorter time frame, like perhaps this was an hourly and we're looking at the 1 minute, we'd be able to see exactly the reasoning behind the formation of this candlestick, which is really interesting, and we're going to go into that a little bit more in detail. But the first sequence shows two small moves and one large move. The small decline off of the open to form the low, which was this little dip down. As soon as it opened, it dipped down a little bit. And then the second sequence shows, let's see. So yeah, the small decline off the open to form the low, and then a sharp advance to form the high, and a small decline to form the close. So that's the sharp advance, and then we had our small decline that basically made it so that it closed with that wick. Because if it didn't dip down a little bit at the high, there would be no wick there. It would have just been a solid green candle at the high. So I hope everyone's following along with that. And then the second sequence shows three rather sharp moves. A sharp advance off the open to form the high, a sharp decline to form the low, and then a sharp advance to form the close. So it was very volatile in this instance. It moved a lot more than this simple bullish candle. The first sequence portrays as strong, sustained buying pressure and would be considered more bullish. The second sequence reflects more volatility and some selling pressure. These are just two examples. There are hundreds of potential combinations that could result in the same candlestick. So that's really interesting. And then this is one of the first candlestick patterns I actually wanted to go over with you guys today, and it's called a doji. And doji refers to both singular and plural form. Doji are very common and important candlestick, providing information on their own as components of a number of important patterns. So they can form on their own, and they can also be part of other patterns. As we're going to see today, they're actually part of many. Dojis form when a security's open and close are virtually equal. So in this case, we can see it opened at this flat line here, at that price. It opened at that flat level, and then it went up to as high as the wick went, and then it also at some point in that candle went as low as that point. Sorry about that. So yeah, and as a result, it ended exactly where it started. Now, that's really interesting. Um, so the length of the upper and lower shadows can vary, with the resulting candlestick looking like a cross plus sign or, yeah, cross. Alone, doji are neutral patterns. Any bullish or bearish bias is based on the preceding patterns and price action. So basically, we can view a doji on its own as a indecision candle, because at the end of the day what happened is there was no real price change in that time frame. And you know ideally, but not necessarily, the open and close should be equal, while a doji with an equal open and close would be considered a more robust doji, it is important to capture the essence of the candlestick. Doji convey a sense of indecision and a tug of war between buyers and sellers. Prices move above and below the opening level during the session, but close at or near the opening level. The result is a standoff. Neither the bulls or the bears were able to gain control, and a turning point could be developing. So when I start to see a doji, it makes me think that whatever trend that we're currently in right now has started to become indecisive, and things might start to change. The bulls have started to disappear out of this large uptrend, and we're starting to see indecision, which could mean change soon. In other words, change of trend. And that's money right there. So, Dragonfly dojis form when the open, high, and close are equal, and the low creates a long lower shadow. So in this instance, we can see that it opened at that top part of that candle. It went as low as this bottom, but then somehow managed all the way back up to exactly where it started. The resulting candlestick looks like a T. Due to the lack of an upper shadow, the Dragonfly Doji indicates that the sellers dominating trading drove prices lower during the session, but by the end of the session, buyers resurfaced and pushed back to the opening level and the session high. So it at some point dropped all the way down and then sucked all the way back up to where it started. Is what this candle is telling us. The reversal implications of a dragonfly doji depend on the previous price action and future confirmation. So if you see this coming from a downtrend, that means the buyers have literally been rejected back to this price level. It's a huge indication, in my opinion, of buying pressure. Long lower shadow provides evidence of buying pressure, but the low indicates that plenty of sellers still loom. So not always will it be a standalone indication, nor will any single candlestick pattern. I think that they're very important as as a part of a strategy, not alone a strategy. So after a long uptrend, while a long white candlestick are at resistance, the long lower shadow could foreshadow a potential bearish reversal or top. So in the other uh, instance, if this was flipped upside down, it's actually called something else. A bearish or bullish confirmation is required for both situations. And what that something else is a gravestone doji. So you can see the similarities. As the dragonfly doji looks like a T, this is an upside down T. Gravestone doji, because basically it is formed when the open, low, and close are equal, and the high creates a long upper shadow. So we can see in this case we've opened at that price, which is the low, and then we've also ran all the way up to this high, and then at some point we've dumped all the way back down to where we closed. Just exactly the inverse of what we were just talking about there. And the Gravestone Doji indicates that buyers have dominated trading and drove prices higher during the session, but by the end of the candle, sellers resurfaced and pushed prices back to the opening level and the candle low. Um, as with Dragonfly Doji and other candlesticks, the reversal implications of a gravestone doji depend on previous price action and future confirmation. So, is it coming from an uptrend? Like, if this pattern is at a low, do we think it's going to go lower? Most cases, it's not. It's not a reversal pattern to the upside. Like, it's not a continuation pattern either. Like, we want to see this pattern occur at the end of an uptrend to reverse it back down, and that is when it can be most effective. After a long downtrend, a long black candlestick, or at support, focus turns to the evidence of buying pressure and a potential bullish reversal on the as it is can be reversed into a dragonfly doji. But yeah, after a long uptrend, long white candlestick or at resistance, focus turns to a failed rally and a potential bearish reversal. Bearish or bullish confirmation is required for both situations. So you want to confirm that with all your other indicators. You want to see like, hey, does this after this pattern, do we have a bearish divergence? Do we have increased volatility? Is there going to be an opportunity here? Is it part of a pattern? Is it at the tip of a rising wedge? These are all questions you want to be asking as you see that. So there's the up close, if anybody can see it. And here we go with another one. So just while we're on the topic of different types of dojis and and so on, this one's quite an interesting one. The long-legged doji have a long upper and lower shadows, but are almost equal in length. So we can see it's almost exactly like a plus sign. It's acceptable to have a little bit of an inner body candle there. These dojis reflect a great amount of indecision in the market because one thing that you see out of this is there was a lot of volatility was apparent. In some cases, you'll get this on news, you'll see this on stocks that recently have received news of some kind, and perhaps that news is indecisive, or perhaps it is yet to be released. You might see things like this, or typically, if it's at the end of an uptrend and you see this, it means danger for that uptrend, and it most likely will start to falter. Depending on the situation. So long-legged doji indicate that prices traded well above and below the session's opening level, but close virtually even with the open. After a whole lot of yelling and screaming, the end result showed little change from the initial open. Indecision, in other words, there. So spinning tops and spinning bottoms are a very similar pattern to dojis, but they are different, and it is great to be able to identify them. But you generally do treat them very similarly. Candlesticks with long upper shadows and long lower shadows, and a small real body are called spinning tops or bottoms, for instance, because this pattern is virtually the same at the end of an uptrend and at the downtrend. So at the end of a downtrend. So you want to make sure that you keep an eye out for this pattern regardless if it's at the end of a long rally comparative to how much it usually moves. Like if you see that it moves in a range and then all of a sudden, it's back to the top of that range and it's giving you one of these, it's probably in trouble. So you check your other indicators and make sure, that you're aware of every other aspect of the trade. But this is one check mark to the fact that it is slowing down and people are getting indecisive of this move, however big it is. So, uh, yeah. So one long shadow represents a reversal of sorts. Spinning tops represent indecision. The small real body, whether hollow or filled, or whether green or red, it means there as well, um, shows little movement from open to close, and the shadows indicate both bulls and bears were active during the session. Even though the session opened and closed with little change, price moved significantly higher and lower in the meantime. Neither buyers nor sellers could gain the upper hand, and as a result, it was a standoff just like a doji. With After a long advance or a long white or green candlestick, a bullish candlestick, a spinning top dictates a weakness among the bulls and potential change or an interruption in trend. A long decline or a long black candlestick, like a coming from a downtrend, if you see the spinning top, um, which in that case would be a spinning bottom, it would weaken the trend of the bears and perhaps interrupt that trend or change it, depending on all the other indicators that support that trend at the time. So that's what that looks like there. And yeah, so here's a little bit more of an advanced one. This is the bearish falling three. So the pattern starts out with a strong down candle, as we can see here. We're coming from a downtrend in most cases. And then we have this nice strong red candle. It's followed by three small real bodies. So we've got three small candles that make upward progress, but stay within the range of this first large drop candle. The pattern completes with the fifth candle, makes a small, well, it actually makes a large downwards move, very similar to the one that initiated the pattern. So essentially, we've started out with a large drop, and then we've stair stepped our way back up within that candle, and then all of a sudden we're right back down, if not lower than where we started. And this is a very common pattern you'll see within bear flags and so on. Um, People will confuse them with that and so on very often. The pattern completes with a fifth candle and makes another large downward move. It shows that sellers are back in control and that the price could head lower. So that's very interesting there. And then the bullish rising three is pretty much the inverse of that. It exactly is. The pattern starts with a large green candle, and then the second, third, and fourth candles are small real bodies to move the price lower, but they still stay within that first green candle. And then the fifth candle wipes all that out and potentially even continues further, depending on your momentum and other indications that you should be using. Um, Even though the pattern shows us that the price is falling for three straight candles, a new low has not been seen. So we're still within this candle. And the bull traders prepare for the next move up. So the slight variation of this pattern is when the second green candle gaps up slightly higher than this first one. And that's actually another pattern there. When this small red candle actually has a gap up and it's actually completely higher than the first one, uh, that that's called a bullish mat hold. But everything else basically works exactly the same. Um, and so you can watch out for a little gap to be within this candle here, and that's okay. And yeah, so this candle would be generally higher than the first initial candle. And the same is true for the inverse. Right? So bullish Harami cross. So a bullish Harami cross occurs in a downtrend where a down candle is followed by a doji. This doji is within the real body of the prior session, and the implication are the same as a bullish Harami. So basically, we can flip this pattern around at the same time here. So we can see we're coming from a downtrend, and then we've got a little doji inside of this candle here. That actually is very indicative of a potential price change or trend change altogether. So we could actually see the trend break and then a new pattern form altogether there. So bearish Harami cross is actually the inverse of that. And basically, we're coming from a downtrend, and we have a small doji within our last candle of our uptrend there. So a bearish harami occurs in an uptrend where an up candle is followed by a doji, and the session where the candlestick has virtually opened at its close. Basically, that's the doji, and the doji is within the real body of the prior session here. So the implication are the same as the last one that we looked at there. So you can see the difference. Bearish Harami is a two-bar candlestick pattern that suggests prices may soon reverse to the downside. So as we can see here, we've got a large green candle followed by a small black candle. The opening and closing prices of the second candle must be contained within the body of the first candle. So you can see how this candle absolutely sits inside of the inner body of this green candle. All right. So this whole candle here, even the wick and the high and the low is inside of the inner body of the last green candle. And an uptrend precedes the formation of a bearish harami. So you know what? Ideally, you want to see this coming from an uptrend. This isn't going to be the first green candle at the end of a downtrend. We want to see 5, 10, we want to be above the VWAP. We want to be overextended to however you measure your overextensions. It could be moving average ribbons and VWAP alerts. I find that they're very effective in order to measure the distance of a trend and determine whether or not, should my bearish candlestick pattern start to work now? Because you don't really want to be trading a bearish candlestick pattern in the first place if it's mid-range or if it's especially at the end of a downtrend. You want it to be at the end of an uptrend or what people would consider high. And that's what I think. Um, but the size of the second candle determines the pattern's potency. The smaller it is, the higher the chance that the reversal can occur. The opposite is true with a bullish harami. Basically, we have the exact same pattern, except it is preceded by a downtrend, and it suggests that prices may reverse to the upside. So you would have a large red candle with you would have a large red candle with a small green candle encompassed within that. People will call these bullish and bearish engulfing patterns as well, seeing as there's a million names for every pattern, but essentially the one thing that you need to know is why it works out and exactly what to look for. Now this is a piercing pattern. It's a little bit more of an advanced pattern. A piercing pattern is also a two candle pattern, but uh, it marks a potential short-term reversal from a downtrend to an upwards trend. The pattern includes the first candle opening near the high and closing near the low, with an average or larger size trading range. It also includes a gap down after the first candle, where the second candle begins trading, opening near the low and closing near the high. The close should also be a candlestick that covers at least half of the upward length of the previous candle's red candlestick body. Um, that one is a little bit more difficult to explain, but if you want to like study that one again, it is actually quite effective. But there's a few concepts in there that are a little bit advanced, I would say. But nonetheless, bearish evening star. This is actually one of my favorite uh, depictions of a candlestick. Now we know dojis, and this is putting dojis in their place. We can see literally we have an uptrend, and it's followed by a doji or a spinning top of some kind, and that literally changes our trend into a nice reversal pattern there. So an evening star pattern is considered a very strong indicator of future price declines. Its pattern forms over a period of three candles, in which the first candle consists of a large positive candle signifying a continued rise in prices, and the second candle consists of a smaller candle that shows a more modest increase move in price, while the third candle shows a large red candle that opens at a price below the previous candle and then closes near the middle of the first candle. So basically, if we remember what a spinning top or a doji does, we've got an uptrend. We get our spinning top or doji, and then we get our reversal as a result. But the one major factor that 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 makes it the evening star, in my opinion, is the fact that it actually has to come from a thick white or green candle, and then it ends with a thick black candle. It's like the evening star that divides the day and night. If you want to use that to remember it, fine. Um, the evening star patterns are associated with the top of a price uptrend, signifying the uptrend is nearing its end. The opposite of the evening star is the morning star pattern, just like it would start at the night and finish in the day. All right. So bullish engulfing pattern is very similar to what we saw a few minutes ago with the haramis, but just to briefly go over it again, the bullish engulfing pattern is a two candle reversal pattern. The second candle completely engulfs the real body of the first, um, without regard to the length of the tail or the shadows. So in order to make it the harami, it actually has to have the wicks inside of the thick part of the candle. Now, people can get them confusing. Essentially, they mean the same thing. So when we see that, generally speaking, whether if you're spending too much time trying to figure out whether it's an engulfing pattern or a harami, you're wasting your time. So that's just another pointer. But the bullish engulfing pattern appears in a downtrend and is a combination of one dark candle followed by a larger hollow candle or green candle. Stronger signals are provided when the red candle is a doji or when the subsequent candles close above the high of the bullish candle. So generally speaking, just like many other candlestick patterns, in order to give them a better chance, you want to see a strong downtrend, and then you want to see this pattern appear preferably very fast and at a high volatility moment where everyone's freaking out and it's at a really, really substantial low. And one other thing that could really help there is if we got a nice trend line going right here at the low of this candle, a significant daily trend line, just support our trend. And then to top it off, we might have a bullish divergence as well. And there's many other things that you can do, but you don't want to use it alone. And you want to make sure that you follow the rules with every single aspect to it. As far as being mid-range, this should not even work. So you want to make sure that it's at the end of a trend. You want to make sure that it's at well, not how would you know it's at the end of a trend, but you want to see it in a strong trend that's at a high point, uh, you know, based on its averages, if you catch my drift. But a bearish engulfing pattern. A bearish engulfing pattern signals lower prices to come. The pattern consists of two candles, an up or green, white or green candle. So basically, we're getting up candles here, followed by one large black or red candle that engulfs this whole last candle. Now, as it mentioned in the last one, the wicks aren't necessarily as important as the inner body. So the inner body of the dark candle has to engulf the inner body of the previous candle. So it's the open and the close of the green candle, or the white candle in this case, has to be engulfed by the open and the close of the next candle. And that's what it's referring to. The pattern can be important because it shows that sellers have overtaken the buyers and are pushing the price more aggressively down than the buyers were able to push it up. Um, a bearish engulfing pattern is seen at the end of some upward price moves. It is marked by the first candle of an upward momentum being engulfed by a larger second candle, indicating a shift towards lower prices. Now this is an interesting one here too, and I've kind of done it inversely. So we can see we have a hanging man candlestick here. Now this isn't to be confused with a hammer, and some people will have heard of that one already because it's a very common one. But I want to start with this one. A hanging man candlestick occurs during an uptrend and warns that prices may start falling. The candle is composed of a small body, a long lower shadow, and a little to no upper shadow. So the hanging man shows that selling interest is starting to increase. The long lower shadow of the hanging man shows that the sellers were able to take control of part of the trading period. But in essence, it didn't finish at the lows because it came back up the majority of what it lost. The candle must have a small real body and a long lower body. So you can see it has a small inner shadow, inner body here, and a long lower wick there, right? Okay. The candle must have a small real body and a long lower shadow that is at least twice the size of the real body. So this long lower wick part has to be at least twice the size of this inner body thicker part here. Um, there is no little, it can have no upper wick. That's fine too. Like it might just finish, or like it not have anything at the top there. It'll just be a thick part. That's fine too. Same pattern. It's okay if it has a little bit of one as well. And this pattern is indicative that the bulls are beginning to lose control and that the security may soon enter a downtrend. Now, the one very, very important part about the hanging man is he's got to have something to hang from. So if he's not in an uptrend, it's not going to work, right? I just wanted to use that so that there's some analogy to work with there, but or yeah, so it's going to be confused with this one here. So as we remember, this is at the end of an uptrend, and it looks exactly the same. So it's not like the opposite of this, or or so on. Wouldn't necessarily be a hammer, but like this pattern is exactly the same in a downtrend, except it reverses up. So, but you would think that it would have a maybe it might perhaps look like. I guess we haven't done that one yet. Or an evening star. Or no. Yeah, we haven't done it yet. Anyways, so the hammer occurs when a security trades significantly lower than its opening, but rallies within the same period to close near an opening price. This pattern forms a hammer-shaped candlestick, but the key is that it's at the end of a downtrend. So we can see a clear downtrend here, and it's a strong downtrend, and it's at the lows, and it's under the averages. Now, the increases of this probability of this reversing the trend is a lot higher if it is in that situation at the end of a downtrend at support with a bullish divergence. Then you're talking more than likely we're going to see a response, or some sort of change in the near future, if not immediately. So that's really interesting. A hammer candlestick shows sellers came into the market during the period, but by the close, the selling had to be absorbed by the buyers and pushed back up to near the open, if not higher than where the stock opened. In a lot of cases, hammers end at the high. Like in this case, it opened at the low here, right? Went all the way down to that low here and finished at the top of that candle. So hammers occur on all time frames, just like every other pattern. Uh, including 1 minute charts, daily charts, and weekly charts. Every single pattern that we have talked about here is applicable on any time frame. Abandoned baby patterns, which is a little bit of an interesting one, seeing as we are back to the use of our doji again. As we can see here, we have a doji that's clearly defined by a gap from the previous candle, and then it's defined as well with a gap down. So in the bearish situation here, we've got a strong green candle with then a gap to start the next candle even higher, and then it makes our doji, and then ends up gapping down on the next candle to start the new downtrend. And we can see that uh, same indication there. The abandoned baby slash evening star pattern is a classic reversal pattern. It's commonly, uh, you know, compared with the evening star doji. Now, an evening star doji doesn't necessarily have to have a gap. The abandoned baby, the fact that it's abandoned up there by itself and it's small and indecisive is why it gets that name. And it's got the gap there too. And gaps can be important with candlestick patterns. So we're going to talk about those soon in a minute here. Um, After a strong trend, the price gaps higher but fails to keep on going higher. The third candle is a strong move in the opposite direction, confirming the change in trend direction. This pattern is most commonly used on daily charts, but can be used on any chart as well. And there can be modified versions as well due to liquidity, because on 1 minute charts, you might have liquidity issues that could present changes in how the candlesticks are formed. Now, during an uptrend, long green candles with a very small candle after a gap up, and then a large green candle, or I mean a large red candle to change the trend would be a bearish one. And then the same uh, situation would occur for a downtrend. We're coming from a downtrend, and there's like 10 red candles or black candles in this case coming down, right? And then all of a sudden we get a gap down. Sorry, we get a gap down to make our doji, and then a gap up to start our new trend. And it should reverse fairly well in this case. Now, this isn't a very common pattern in my opinion, but when it happens, it's definitely something you want to be attentive to. The most important part of this pattern is that you wait for the third candle, which validates the reversal and the pattern. That's if you haven't already shorted the doji. But let's see. Tweezer tops and bottoms. The tweezer top is a pattern commonly involving two candlesticks that can signify either a market top or market bottom. Now, this is really interesting because it has two similar candles, but the wicks are at equal length and preferably on support. This could be a fib line that's stopping it from going down. It could be a support line, many different things. And it's very, very similar on the way down. So we have the exact same thing except reverse for tweezer tops. So tweezer patterns are reversal patterns and occur when two or more candlesticks touch the same bottom for a tweezer bottom pattern or for a tweezer top pattern. Now, you can also have two thick candles at the low as well. So that's another thing as well that would count for a tweezer top and bottom. Tweezer bottoms are considered to be short-term bullish reversal patterns, whereas tweezer tops are thought to be bearish reversals. So bearish tweezer top occurs during an uptrend, and just like any other bearish pattern, we're looking for an uptrend, and then the bulls push the prices higher, often ending the candle near the highs. Then on the following candle, the traders reverse their market sentiment, eliminating most of the prior period's gains. Bullish, and usually all the period's gains. But a bullish tweezer bottom is realized during a downtrend when the bears continue to drive prices lower, closing the candle near the lows. And again, candle 2 is a reversal and then quickly eliminates the losses from the previous trading candle. All right. So this is another common one here, dark cloud cover. Dark cloud cover is a bearish reversal candlestick pattern where the down candle, typically red, opens above the close of the prior candle, which is a green candle, and then closes below the midpoint of the upper candle. So it's kind of giving it a shadow on that other candle, basically. It's kind of signaling that, trends have reversed and it shows that the momentum from the upside has shifted to the downside, and the pattern is created by an up candle followed by a down candle that traders look for the price to continue lower on the third candle to give it confirmation. All right, and then this is what it looks like here. So we've got our green candle here. This candle is kind of casting a shadow over our green candle, and then the third candle is the confirmation that this candle was the change in trend, and we want to pay attention to a potential break of whatever uptrend we're in. So this is the San-Q pattern, the three gaps pattern. Now this one it takes into account three different gaps that can occur, and how often do we see that happen? We don't usually, but when we do, it's great to understand that this pattern could be in play. So the San-Q pattern is an anticipatory trend reversal signal, and the pattern does not indicate an exact point of reversal. Rather, it indicates that the reversal is likely to occur in the near future. So it's not an exact this is going to happen as a result of seeing this. It's hey, let's watch out. Where's that next resistance? Where's our next bearish divergence going to confirm for us that our resistance is going to be holding? Um, the pattern is created with 3 trading sessions in a row with gaps in between. So as we can see on here, we've got our first trading session with a gap to the next trading session, then a gap again to the third. While each candle doesn't necessarily have to be large, usually at least 2 or 3 candles are. Uh, Here's a 3 gaps pattern that is signaled at the end of an uptrend. The price is accelerating higher, whereas the 3 gaps higher in a row, such momentum can't last forever. The buyers are eventually exhausted, and the price moves the other way. So as we can see here, our first candle, and our second candle are completely not touching. The wicks aren't even overlapping. There's no overlapping from the candles, and then it happens again on the third candle, and now we're up in an uptrend, and then the short term uh, price action is usually reversed in the near future after seeing that. So the entry and exit for this pattern is a little peculiar. So the pattern operates on the premise that the price is likely to retreat after a sharp move, like a spike top or something, because the traders will start taking profits. For an additional evidence of the possibility of a reversal, look for extremes in relative strength or a weighted crossover or bearish divergence in the MACD. And then the patterned exit could also be on a fib level with a bullish divergence, and you can use the same thing with an RSI and MACD as you did to get into the trade. But if that doesn't happen, if the reversal doesn't happen, you can get out of the trade because you want to make sure that the price follows through the anticipated direction in order for the signal to be valid. So you want to make sure that you get a clear trend break. And even, funny enough, in this instance here, if you guys have studied trend lines with me, you'll notice that when a trend line breaks, it actually comes through and tries to retest. And in this case, it actually did do that. So you can look for other characteristics as well within these candlestick patterns. So the price must follow through in the anticipated direction in the order for the signal to be valid. A stop loss orders can be placed above the high of the current pattern if going short. Ride the downward momentum while it lasts, and since it is unknown how long the sell-off will last, take profits when you see a reversal signal in the opposite direction or when selling momentum slows. So this is a kicker pattern here too. The kicker pattern is one of the strongest and most reliable candlestick patterns. It is characterized by a very sharp reversal in price during the span of 2 candlesticks. In this example, the price is moving lower, like it's coming from a downtrend, and then the trend is reversed by a gap and a large candle in the opposite direction. So we've gapped up and then had these huge jaw-dropping candles on whichever time frame you're trading on. The first green candle is the kicker candle. The second strong green candle shows that the follow through of the first powerful pattern helps confirm the reversal is in place. Generally speaking, if anybody's familiar with the 3 bar play for the uptick short that we covered in one of our last lessons, you can definitely see how it down ticked a little bit there. It started basically flat, a little bit lower, down ticked a little bit, and then it absolutely continued that trend. No, those are patterns that we see generally at the end, at the low of a downtrend, and this is the first ignition candle to break that trend as well. So when the first candlestick opens, the price has an upwards direction that basically it has an upwards direction and that rising movement continues throughout the candle. However, the following candle, while opening at or near the previous candle's open, continues to move the price downward. Um, the price never rises into the previous candle's trading range, causing a gap. Due to its significant change in direction, it is usually safe to assume that the second candlestick's downward movement will continue a fair amount of the time. And this can be a bearish kicker. Bearish kickers often appear at the starting or of a news event, or it could be Trump talking. It could be uh, the Fed talking. Depends. We saw a bullish kicker the moment that the Fed stopped talking on Friday. There, as soon as if you want to look back, you can see exactly where the trend changed on the Nasdaq. Um, right at the end there. Yep, and we basically had a huge green candle to start our new uptrend. But you can notice how it's actually part of a falling wedge. It's probably got a bullish divergence, which it does, yep, and then it reversed with a bullish kicker to confirm the whole thing. Now that's really interesting. Now back to this. Um, it is most relevant when it forms in an oversold or overbought area, but regardless of the area and trend, the gap between the candlesticks illustrates strong and meaningful change. There is a high level of selling pressure as well. So yeah, island reversal patterns. Now this is very similar to our abandoned baby pattern here, but island reversals are strong short-term trend reversal signals. They are identified by a gap between reversal candlestick and two candles on either side of it. So here's a bullish example on our top one here. Then the price is moving down, it's coming from a downtrend, as we can see here. Then the price gaps lower, so there's literally a gap between these two candles here, and then after that candle here, we get a gap in the other direction, very similar to an abandoned baby. But I just want you guys to understand that people will call them different things, and they'll expect you to think that it's this. So the entry of the island reversal shows the indecision and the battle between bulls and bears. This is often characterized by a long-ended doji. So, for instance, we could have a gravestone doji there. We could have a dragonfly doji at the low here. That's also acceptable. Could be, yeah, exactly. And it is after the gap and the move in the opposite direction that the trade is actually taken. The confirmation that the trend has been broken and we've actually gapped in the other direction, that's a great signal that the trend is actually going to be continuing. Now, if you're already in a trade on say you caught the support, or I mean, sorry, the resistance here, or you caught the support of why it turned around and made that pattern, this is added confirmation to be like, hey, I'm going to try and ride this out a little bit longer. So for a bearish pattern, you enter the short after the gap and is moved in the opposite direction. Um, yeah, and Yeah, and with this pattern, you want to capture the thrust in price that follows the pattern. But once the thrust starts to weaken, it's time to get out. Or if it hits resistance, you want to apply fibs. As soon as you see a pattern like this, that gives you that predominant higher low to be able to end your fib at, to be able to determine exactly where that next trend is going to be. So, like for instance, in this case, you could start your fib at the end of the uptrend or at the end of the downtrend here, and finish it at the high to figure out where it's going to come down to. Or in this case, you would on the bullish one, you'd start it at the high, finish your fib at the low, and then you get levels to see exactly where you might want to get out at. So this is the hook reversal pattern. The hook reversals are short to medium term reversal patterns. They are identified by a higher low and a lower high compared to the previous candle. So a higher low and a lower high compared to the previous candle. Here are bullish and bearish examples of this pattern. So for instance, in the bullish example, we have a lower high and a higher low, and then a higher high and a lower low, or lower low, sorry. Basic patterns, and on the bullish pattern, there's a downtrend. So we're coming from a downtrend, and it's followed by two up candles. For the first and second candles, breaks the high of the last down candle It is the second up candle where the long trade should be taken, and then a continuation should be expected. And especially if you are measuring it based on your other tools, I think that that is definitely going to give you some added probability. And we definitely want to take a look at that there. All right, blending candlesticks. So now that we know a few candlestick patterns there, we're actually going to talk about how individual candlesticks can actually form other candlesticks. So this is quite interesting actually. So candlestick patterns are made up of one or more candlesticks and can be blended together to form one candlestick. So like three 1 minute candles might form one 5 minute candle that portrays a different um, outcome. So we're going to take a look at these here. So we've got, for instance, we've got our bullish engulfing pattern where we've got our small candle, and then a large green candle that engulfs the smaller one. So throughout that time period, we may we basically opened, no, we opened here and we fell down to basically as low as this part and this candle, and then the next candle started. We basically made it down to as low as here, and then at some point came all the way up to the high and finished close to the high. So if these were two 1 minute candles or two 3 minute candles, the 5 minute candle might look like this, is what I'm trying to say. So let's see here. So by using the open of the first candlestick and the close of the second candlestick and the high and low of the pattern, a bullish engulfing pattern or piercing pattern blends into a hammer. So if you're looking at a piercing pattern or a bullish engulfing pattern, you can find that on the next time frame up, you'll be looking at a hammer because they've blended together. So when you're looking at the 1 minute candles, you can actually try and decipher exactly where they've been within that candle. If you're paying attention close enough, you'll be able to see that it moves within that candle as well. And it's not only the end result of what the candle looks like, but how it moved while it was making that candle, which can determine the next candle. If you catch my drift. But yeah. So this is another example. So we've got our piercing pattern, and then our which equals our hammer, or our dark cloud cover, which equals our shooting star. Blending candles, blending the candlesticks of a bearish engulfing pattern or a dark cloud cover, uh, basically creates the shooting star or the hammer. The long upper shadow of the shooting star indicates the potential bullish reversal, as well as with the shooting star, bearish engulfing and dark cloud covered patterns are all required to give us bearish confirmation or bullish confirmation, which is really cool. So then this is I should have done this one first. So basically, if we have three up candles on the 2 minute, our 5 minutes going to look like this, because it's going to be one thick candle that will incorporate all of the moves that we've had prior to making this candle. And that's what I really wanted to show there. But more than two candlesticks can be blended using the same guidelines. Open from the first, close from the last, and the high and low of the pattern. Blending three white soldiers or three long candlesticks, um, uh, and blending three black crows represent a black candlestick. So yeah, no, I just wanted to, if anybody has any questions on any of the candlesticks, I would be happy to go over them with you. But if not, I actually have some questions from an anonymous member that is interested in understanding these. So I just wanted to briefly go over them with you here before we conclude. So where to set stops is a very common question too, and I'm very happy to answer that. So in my opinion, I think that stops should always be set at technical levels that refer to your trade and um, shouldn't have any kind of uh, they shouldn't tie into your profit and loss, because as we talked about many other times, profit and loss actually is an emotional thing for many traders, and it can make them think and completely forget about their trade. It can make them think irrationally and think about forget about the trade. So instead of putting it as like $100 or $50 or $10 or whatever you want to put your stop as, put it slightly beneath the support you're buying off of. Put it um, a few points to give it a little bit of liquidity. It's just or a little bit of volatility, um, like defense there, so that just in case it does move around a little bit, you're safe. But essentially, if it was to clearly break the support you're buying off of, you're wrong, so you get out. Or if you're shorting at resistance, you put it slightly above the resistance, slightly above the trend line you're shorting on. What setups should you start with? In my opinion, the best setups to begin with would actually be rising wedges and falling wedges. And if the market is overall in an uptrend, we want to be looking for more rising wedges as things get shot down all the time in uptrends, and finding the reversal to the major trend in the first place is going to put you at better odds with making a larger profit and being able to hold it for a longer time. So that's what I would say there. Rising wedges and falling wedges with bullish and bearish divergences. I actually have a really good video for uh, beginners on that, and we'll definitely get that out there again in the chat too. But what technical setups should you have? Friday's talk was nice because I had a desktop, but what about charting programs, trading platforms, indices, and other hardware? And how many screens? Okay, so that's a good question. Um, you know, you can start with a few technical setups and wait for we can do like a rising wedge and a falling wedge. We see them every day, so we can safely say that you know they are out there, that we do play them. They are effective patterns, and when analyzed correctly, they can be quite lucrative. And I would say those patterns are great because you're going to find them that like they're there every day, and we've proven that. And I would focus on things that are easier to find and things that happen more frequently. So that would be number one. And seeing as you've got a desktop now, and a lot of the guys that come in and trade on phones are now switching to desktops and really really enjoying that too. So that's a really good step in the right direction. If anybody in here is listening on their phones and trading on their phones, you definitely want to look into getting a desktop if you're looking at doing it professionally. Anyways, um, what about charting platforms? Now, charting platforms, it's really interesting because you wouldn't think it, but there's a website called TradingView. It's the one that I like to use to chart on. No matter what platform I'm trading on, I still use TradingView to chart on because uh, they can be free, especially if you're starting out. I don't really think that you're going to need the paid part of it, but everything is free and you can get access to every single thing that you need. If you require extra indicators and you require certain indicators like volume profile, then you would have to pay, and it's relatively cheap. I think it's $6 a month or something like that. Um, but how many screens do you need? I would say three would be really good. One of my favorite ways to trade would be one vertical monitor in the middle and two horizontals on each side. So, or one horizontal on each side. So it gives you three altogether. You've got your vertical monitor in the middle, and then you've got one on each side. If you can make it two on each side, you're doing even better. More the merrier in that case because you get more information. But you can trade with one, you can trade with two. It all depends. And if you wanted to shortcut it until then, you could always plug in an HDMI cord to a TV and plug it into your computer and get that extra screen if you needed to. And I can't not mention projectors because I actually have been trading off of projectors. I find that they can you don't miss a candle when it's 300 inches on your wall. So that's my that's my new thing. What I like to do at home, at least, I project it onto the wall with a relatively inexpensive, high-powered projector that you can get on Amazon for like $200 when they go on sale. Um, and nobody's buying them right now, so you can get them on sale probably. So, anyways, um, as in comparison to a $200 laptop or a $200 monitor, never feel good about that. But anyways, um, everyone looks at forex, commodities, and indexes and stocks. So what should you focus on to start with? In my opinion, and this might sound strange to a lot of people, but I think that learning futures to begin with is actually better because it's where most people seem to end up anyways. And there's a lot less concepts that you'd have to teach and learn and in order to understand the concepts of trading the futures contracts on the major indexes. You would focus on the Nasdaq, the Dow, the SPY, the Russell, and perhaps gold. I always like to fit that in there too. But that's five different things that you can trade. The markets are more than volatile enough to make plenty of money off of, and there's a lot of new news events that come out, um, that we can take plenty of advantage of and have been taking plenty of advantage of. And I would suggest beginning
Futures
with
just open, Brad.
what's up?
Gap down. Futures just open.
Beautiful. I'm flat, so I'm not too worried about it. But I'll try and conclude this up here so we can get to trading. Everyone looks at forex, commodities. Yeah, I would start with the major indexes, trading futures. Let me know if anything crazy happens there, though, Jacoby. But
Yep, yep, yep.
I have a forex account. When do I buy a forex pair, futures forex pair, or just half the pair? Like on Friday, the dollar was going nuts, so it was buy or sell the dollar DIY. Now, this is a really interesting question. So, if you have a forex account, you'll be able to trade multiple different currency pairs. Now, everyone doesn't just trade one currency usually, and when you're trading futures, you basically trade whichever currency you want against the US dollar. So when you have a Forex account in particular, you can trade certain currencies against each other without the US dollar even be coming into the picture. So one way that people like to get exposure to the dollar is to actually trade currency pairs such as the euro US dollar, which moves opposite the dollar in most cases, and then you have other currency pairs that you can actually trade that give you exposure to the dollar. Um, Now, I would suggest practicing for sure for a while before getting involved with that. Because there's different news events that occur in different countries, and if you're not on the ball with that, you're in a position, it could blow right through your stops, and the leverage is extremely high. So I would refrain from that as a newer trader. But yeah, and you may start to trade some futures forex pairs, which are all right, but generally speaking, forex you might want to research a little bit more, I would say first, which is okay. Now we got our next one. Now it seems that I can start a harmonic from anywhere. How do I end it? How do I know where to end it? Meaning, how do I know where to draw it to? Um, is that a visual thing or an indicator thing? So harmonic patterns are interesting, and this is really, I'm going to briefly go into it. They're called harmonic patterns because they work in harmony with Fibonacci's. And you know how it's like, should I learn Fibonacci? Should I learn harmonics? Everything like that. Well, the first thing is you're going to have to learn Fibonacci's in order to be able to learn harmonics. Because they work in harmony together, and it's almost a requirement to have the bearish, or sorry, what am I saying? It's almost a requirement to have the Fibonacci's down pat first before you get into the harmonic drawings themselves. And you know what? We have a great class on that actually, um, for learning harmonic patterns and exactly how they work and every different variation of them and exactly how to draw them and what those exact parameters are. So the X point to the A point should result in the B point ending at a fib, and then the C point ending at a fib, and then finally the D point ending at a fib. And that's why they work in harmony together there. So why the 1 minute, not the 5 minutes? So you're not constantly having to react. Is it due to the cost of the instrument or cost of the move? I.e., on the 5 minute, 1 bar costs you the same as 5 bars on the 1 minute, so it's better to do the 1 minute moves because you have the possibility of losing less. It seems like the 1 minute moves fast and sometimes people miss trades. So that's a good question. And that's probably my bad for not explaining properly what we do, I guess. But the way that we like to trade is actually from a top-down approach. Every single time frame is within consideration. Now, for me, I can look at the 1 minute, and because I understand blending candles, I don't need to look at the 5 minute because I have a better picture of exactly what's going on with the 5 minute. It would actually be a waste of time for me to look at the 5 minute because I would be getting less information on how that 5 minute was formed, as opposed to actually being able to look at the 1 minute or the 30 second or the 10 second or the 5 second and be able to see every single movement of how that small pattern was formed and gain even more of an understanding of what potentially could happen next. So I think it's considerably less noisy to trade off of a longer time frame. But there's a lot more that's going on that we're basically turning a cold shoulder to, and I like to know everything about everything when I'm trading. So I don't stick to one particular platform because of it. Like I don't check the 1 minute unless I've checked the daily, the hourly, and I understand exactly where everything is, where we are in our daily range, where we are in our hourly range, and as long as I give the whole day a once over on the 1 minute to zoom right out and just make sure I'm seeing everything right and make sure I have trend lines on all the highs and all the lows and everything is accounted for. And then I'll move in to zoom in to my scalp trading setup where I can actually um, use those trend lines that I've connected and color coded in order to determine exactly where we are and exactly what information I need to be focusing on in order to get the best entry possible. So I hope that's good. Why can it be a higher risk to hold overnight or through a break? Now that's a really good question, and that wouldn't have been asked as much if you had to come in a month ago, I would say. But last week in particular was a very interesting week, seeing as we had the Fed talk more that week than we have, I think, in any other week for the past like year. Like they literally hammered it out last week, and they talked for hours. I've actually never seen them talk that long before. But then again, I'm not. I don't really. Um, I don't like to watch them because I don't get my trading decisions from what anybody says. Any news event in the world, could be falling apart. It won't influence my trades because I've got to see that rising wedge with the gravestone doji, with the bearish divergence, with the so on and so forth. If that doesn't work, I don't do it. I could care less if the world's on fire. If it's down with that grainstone doji, I'm buying. You know what I mean? Like that's the way it goes. Unless there's, like it all depends. There's so many different circumstances, but at the end of the day, those small uh, news events and even big news events, I generally like to play the outcome and the response instead of the anticipation. So whenever news hits, just for anybody that's new here, whenever news hits, the news will drive the stock in whatever direction. Let's say it's good news, it drives it up, and then where does it reverse at? The next resistance level. If it didn't, it's like every single time. There's not been one time where a stock has ran up on news and fallen without it falling from a resistance level. Because what did it just create when it fell? A resistance level. And usually there's something there in order to uh, confirm that. So that's interesting. But yeah, why is it risky to hold overnight through the break? Sorry, I got a little sidetracked there. But through these times, they generate a lot of anticipation and a lot of indecision. And as we can see, there's been more and more symmetrical triangles and more indecisive patterns that show the indecisiveness of the big players that play in the market nowadays. And especially when the market is trading on a day where the Fed is talking, we definitely want to remain the least amount of exposure to any surprises that we can have. Like at all times, you want to be complete control of your trading account. You never want to be like, oh, I got into this position. I wonder what's going to happen to me tomorrow. No, never do I say that at all. I never say, oh, what's the market going to do to my portfolio tomorrow? It's never like that. It's always, I can't wait to get to the computer so I can smash out the next trade because I've done it and understand exactly how it's going to react because it's been doing it for since before I was born, and that's just basically the way that it always is. Technical analysis is the analysis because of the way that it works and the way that it is like. We'd all be broke if it didn't. Like literally, this would not exist if it didn't work. So And usually you'll see it on a day by day basis that we implement it very frequently. Like people are used to 25 trades a day. Right now, we might only be doing 5 or 10. And that's because we want to remain safe and we want to have the highest probability possible. And at the end of the day, if the market went flat all day, there's not going to be any opportunities. If the market moves, we can only make as much money as the market is willing to give us any given day. There's no I'm going to make $1,000 a day every day. How can you say that when you don't know if the market's going to move? So say for instance, if you're trading along and you're like, "Oh, I'm supposed to make $100 today. The market's flat." You're going to start making trades because you want that money when there's no trade there. And that's absolutely horrible trading in my opinion. And that's why I don't go for price targets. I don't like to think about the profit and loss. It'll screw you up and it'll screw your trade up. What you want to think of is the trade. Is this trade going to play out from where I think it's going to be with to where I want it to go, and me putting a confirmed, hey, if it breaks this support level, I'm wrong, every single time? If you can focus on that and follow that, no matter how crazy the world news gets, turn it off, man. Just watch when it happens and don't get emotional about it. And when it does happen, be aware of, hey, Trump's talking at 6, so sit there, watch it, or news event happening at 6. Wait for it to happen. Wait for that huge thrust up to your 61.8 resistance line, or to your trend line that you've been watching all year, and it just broke up off the news and absolutely came up to it, and then all of a sudden you start to see this gravestone doji at your resistance, man. That's where your trade is. Not oh my goodness, Corona or something. It's not that. And we've seen that. It's easy to go out there and find people that have been burned on their thoughts. Coronavirus supposed to bring the market down and everything. Look where it is now, back at all-time high. People were wrong. Anyways, uh, what are the indicators which you use at the bottom of your screen? It looks like the MACD is one. Not sure if the settings though. I know you're purely technical, but the indicators help to verify what you're trading. So that's also why you use them. Yeah, yeah. So I'll briefly go over what I got here. Um, the two indicators that I like to put at the bottom of my screen are actually, one of them is the multi-time frame RSI, and the other one is the
Can't
MACD.
see your trading view if you're using that, John. I just see the questions.
Oh. Um. Well, what I'll do is I'll actually. Do you have those handy? Can you throw them in the chat real quick, Jacob?
Yeah, give me a sec.
Thanks. That'd be great. So Jacoby's gonna get you those two indicators in the chat. You'll be able to search them up on TradingView, and and then if you have any more questions on how to use them, or exactly what's going on there, I'd be happy to help you. But they are also all in the videos as well. So do I ever look at CO2 reports, or are they too far out and not relevant for the 1 minute trading? That's a good question. So all reports are very, very interesting. You want to be aware of every single report that's happening. No one report is any more significant or less significant than the rest, in my opinion, because they all generate volatility. They all have the potential to generate a lot of volatility. Some of them are a little bit clearer that they should be watched out for. Like if everyone is watching it, if it's not something that usually happens, if it's something that is expected to have an extreme price change, yeah, you wanna watch out for that. Probably dump your positions before you get into it, or put a tight stop, or preferably I'm all for dump the position, wait for the move, then play it in the other direction. That's what I like to do. Highest probability doing that. Then hey, oh, I'm gonna get into this trade and then the news is gonna hit. What's it gonna do to me? No. It could be really bad when you give the market the control of your account like that. I've heard of ways to set up hotkeys to make your trades go faster. Is that on the platform or on the brokerage, or a myth? No, that's a good question. So it is not a myth. It's actually really helpful. I think when you're scalp trading, when you're doing short-term trading, it's definitely really easy to get in and out of trades using hotkeys. Now, this is something that you want to have down pat before you do it with your real money. You want to get in there on your trading account, set your hotkeys up, and uh, and really try to uh, you know make sure that you're comfortable with it before you do it on your account, because you never know, man. Like if you've got like a kid or something's on your lap and smacks the keyboard, now you're long 10 shares of or 10 contracts of NQ, and then yeah, no, you don't want that. So if you're like no risk, like you don't have a cat or something that could walk on your keyboard, like there's things that could go wrong there. So you definitely want to watch out for hotkeys in that sense. But if you're sitting there and you're like, this is my zone and nothing's coming around me, and I want the fastest executions possible, and I know exactly where all the keys are, you probably have an edge. So it's a double-edged sword, right? Um, so how do we best translate what's going on the screen to a micro trade? Or should I assume that if something looks good on the SPY, it's good on whatever level that you're trading? Yeah, yeah. So the micros and the minis have the exact same charts. The SPY should have the same chart as MES and ES, except it only trades during market hours. So you'll see that the ES and MES will trade all throughout the night, and perhaps they might be a little clearer. They are all derivatives of the SPX index, however. So regardless of what you are trading, they are all tracking the index. So sometimes you'll see that'll have different prices. Like you can trade futures contracts of next year in December. Now I'm sure they're going to look a little different because that's what people think it's going to be doing at that time next year. So it's very interesting. But generally speaking, if you're going long in MES or you're going long on MNQ and some other guys going long on ES or NQ, they're taking the same trade as you, they just have more in it because the contracts control more money on the same thing essentially. What is more important for me to initially focus on, harmonics, fibs, or something else? So fibs before harmonics. Fibs are must-have if you're looking to try and get out of, but a general understanding of everything. Yes. So most people in finance will tell you you have to be an options trader. You're going to do this your whole life, and you're going to be a little ant in the part of this big firm, and you're going to have your specialty. I don't agree with that at all. I think that you want to know absolutely everything that you can about trading because it gives you an edge. You don't want to have a specialty. You don't want to have anybody have an advantage on you. You want to understand it and then determine that it's crap or something like that, and then not do it, and to determine that this is a way better, more lucrative way for my style of trading and for what I want to do and what I want to achieve than doing something like that. So that's the way I see it. But understand it all. Like you want to be able to talk about somebody about bonds. You want to be able to understand them. But you might not trade bonds. You might trade futures contracts on bonds. That's a whole other ball game. People that trade bonds usually put in hundreds of thousands of dollars and wait and sit, and then they barely touch their trades. Guys that trade bonds using futures contracts trade the micro movements of contracts like UB and ZM and all these other things. Definitely talk to C-Bond if you're interested about trading bonds, but that's futures contracts on bonds. He's not interested in the other style because he wouldn't be making nearly as much money at all. He would have to have maybe $1 billion to be even coming close. But and that's my opinion, though. Obviously, the circumstances could be different. It all depends. But nonetheless, there's different ways and different things that you can learn. You'll realize, like just like anything in life, like you'll learn. You might have started on penny stock trading. You'll learn the risks to that. You'll be like, I'm not comfortable with this. I don't see the ease of consistency. I see sporadic volatility and all this stuff. You might not be interested in that. You might not be interested in the fact that options weigh your trade down with theta and all these Greeks. You might not want to look through the options contracts chain and have to pick out of 500 different securities which one you want to go long on just to get a minor exposure to a trade, and then all of a sudden, whoops, you picked the wrong one and now you're screwed. So you might not want to have to go through that again. So you might be like, oh, it's just a lot easier for me to sit down, type in /MES, and go long one quantity and then sell it when I'm done with it. Bam. That is easy. That's futures trading in a nutshell right there, to be
So
honest.
John, for some of you guys that don't understand,
Yeah.
is when there's people trading the full size contracts in chat,
Yeah.
that's it's okay trade is trade the micros, right? Like
Of
they're
course,
the
you're
actual
trading the
micros,
same
right?
thing, you just have different exposure. It's like somebody buys 100 of worth of something and somebody buys one of something. They're in the same trade, except they've got different levels of exposure. Somebody buys MNQ, they've got like they've got like a small position. Somebody buys one NQ, they've got a large position on the same thing. So if the Nasdaq index moves up one point, both of them are going to have 1 point in their accounts because they're both trading that same thing. Because NQ and MNQ are derivatives of the Nasdaq index. So you can trade the Nasdaq index by trading the futures contracts. Just like you could buy QQQ, you could buy options on QQQ. You're getting exposure to the Nasdaq indexes. You're just using a different way, a different vehicle. Like buying the shares in QQQ is one vehicle of using an ETF to get exposure to the Nasdaq index, or you could buy MNQ, which is exposure to the Nasdaq index in the way of a futures contract. You could buy options calls on QQQ or TQQQ, which would give you the same exposure to the upside in the Nasdaq, just in a different fashion with different ramifications to the trade. And yeah, by far the easiest way to get exposure to the Nasdaq is to buy a futures contract, in my opinion. Then to figure it, then it's like it's very simple to do it with shares too, but for the average person, I would find it would be more complicated for me to explain exactly why we would be buying how many shares of QQQ as opposed to how many shares we would be buying of Nasdaq futures contract. But yeah, no, I think that's everything. Don't forget to join us every Sunday at 5 p.m. Eastern for our class, and check out our Facebook for more information on Legatus Trading as well. And we trade all day long during market hours as well. Also, don't forget to check out our videos tab too. This recording will be in our videos tab as well in like about 5 minutes. So yeah, no, we're gonna take a look at the markets now. If any of you guys have any questions, let me know. I'll be happy to help you right now if you want.
John, I have a quick question. Do you have a slideshow of everything that you presented today in terms of candlestick?
Oh, like the slides for the class?
Yes.
Of course, I'll send them to you. Oh, that's no problem. Yep, definitely. So yeah, no, that looks good. I'm gonna shut off the stream now, and